Hello again. I'm back. My name is Manesh Samtani. I'm the editor for Regulation Asia. Our next panel is on sanctions and PEP screening in Hong Kong and beyond. Obviously, in recent months, sanctions and PEPs have come into focus in Asia, particularly in Hong Kong, tensions between China and the US and all that. We're not here to have a political discussion, but we're here to talk about some of the risks financial institutions are currently facing and how these risks can be managed. And I'm very happy to introduce our panelists, all experts in their field. First off, we have Nick Turner of Counsel at Steptoe and Johnson in Hong Kong, and a contributor to Regulation Asia, I might add. Nick specializes in economic sanctions, international regulation, and compliance. And in fact, he was recently named one of Global Investigation Review's 40 under 40 for 2020 in recognition of some of his work in investigation. So congratulations, Nick, on that. And welcome to today's discussion.
Thanks, Manesh. Glad to be here.
Also joining us is Ola Fundowicz, Regional Head of Sanctions for Asia Pacific at MUFG Bank. Sorry, I hope I've said your surname correctly. Prior to joining MUFG, more than 3 years ago, Ola was at Citi for about 6 years in various AML and sanctions related roles. And again, an expert in her field. Welcome, Ola.
Thank you. Thank you for having me.
You're welcome. And finally, we have Rachel Woolley, our let's say technology specialist here. As Global Director for Financial Crime at Fenergo, Rachel helps financial institutions with sort of client life cycle management. She's also a specialist in compliance matters related to AML, sanctions, and PEPs due diligence. Welcome, Rachel. So you must all be very popular at the moment, given the current environment. So an extra special thanks for taking the time to join us today. So just to remind our listeners, any questions you have, feel free to post them to the chat box. We will try to get to them. And if we can't, happy to address them by email or chat afterwards. I would like to, of course, start with Nick, ask you to kick off the discussion by discussing some of these recent events occurring between, Hong Kong, China, and the US, sanctions activity we've witnessed, and perhaps pulling that across to the region as well, just to sort of form the background for this discussion, if that's okay, Nick?
Sure, happy to do that. There's a lot to say, and I'm struggling to decide what key points to bring out for this conversation. But I think the one that most people would know is that on August 7th, the U.S. Office of Foreign Assets Controller, OFAC, sanctioned 11 Hong Kong and PRC government officials in relation to Hong Kong. As Manesh said, we're not here to have a political discussion, so we don't need to get into the reasons. But the impact is that these individuals are specially designated nationals, SDNs. They all also happen to be PEPs. And that's why I think it's such a good example for this discussion. We can talk about how financial institutions pre-identified some of those accounts and prepared for those sanctions, and then how they responded once the sanctions were issued. Now, alongside that, we've had some other developments, especially in relation to the US-China relationship. This includes sanctions against companies and individuals operating in the Xinjiang region of China, as well as companies that were placed on the entity list in relation to the South China Sea. Now, the entity list is different than the SDN list. The compliance requirements are very different, but the screening solutions are actually the same technology and often the same process for clearing alerts or escalating them. And then, of course, you need to have a process once you have a true match. These are all complicated issues developing rapidly, involving many US government agencies and lots of very sensitive and highly political issues. And those of us who are working in this field have really had to stay on top of this while relying on our technology to ensure that we are able to update our internal screening lists and perform the compliance steps that we need to perform as quickly as possible and as effectively as possible.
Thanks so much, Nick. That I couldn't have done a better job. That's a great recap. Ola, I guess speaking from a banker's perspective, I mean, it seems like all of this might be putting banks, and you see all the media articles, some of them might sound a bit more dramatic than they are. But in any case, we are seeing that banks are being maybe put in a very difficult position. So I'd just like to get your thoughts on how banks are responding to these circumstances Nick has just kind of talked about.
So I think the biggest impact is of course on Hong Kong. So financial institutions that are based in Hong Kong, headquartered in Hong Kong, or have a major branches or offices in Hong Kong, probably would be the most impacted. But I've seen and I heard extreme from banks that considering closing operations in Hong Kong, completely exiting Hong Kong, looking for other hubs in the region to move to opposite side when banks choose to quote unquote ignore US sanctions for now and just stay aware. Probably the biggest number of financial institutions taking a wait and see approach while they are screening their databases, while they are checking if they have any exposure within their customer database, what is the nature and the size of this exposure, whether there are any potential current or future conflict of laws. They are engaging their legal departments, external legal, just staying aware, considering various options for the future, right? Also considering their footprint in US, footprint in China, strategic direction of business development, all that will have to look at, the banks will have to look at it very holistically to decide what to do next.
Thank you, Ola. And I guess you raised that point about ultimately it's about managing the risk, managing the exposures. Nick, what are the issues that financial institutions should be focused on when managing exposures to sanctioned individuals?
Sure. Ola has brought up a good point, which is that financial institutions, particularly in Hong Kong, have taken different approaches, particularly in relation to the China focus sanctions or Hong Kong focus sanctions. I don't think there's easy answers. When we talk about something like Iran or North Korea or terrorism or narcotics trafficking, it's easy for banks to say, we're just not going to do business with SDNs. But I think increasingly, because of the nature of the companies and individuals who are being targeted, financial institutions in the region have to have a more nuanced decision process for balancing all of the considerations which might be important for them. And US sanctions is probably just one of those considerations. So some of the things that they have to be concerned with, obviously there's the regulatory picture. These sanctions tend to apply to US persons. That means individuals who are nationals or green card holders, people who are inside the United States, and US incorporated companies, as well as their overseas branches. Most people are surprised to learn that US sanctions, in most cases, do not apply to foreign subsidiaries, even of US companies. Those are considered foreign persons from a regulatory perspective. So the balance here is making sure that if you are in a legal vehicle or a company that is permitted to engage in transactions with these sanctions targets and you choose to do so, that you're able to ring fence that activity from a US nexus. That could be the US financial system or US persons. In some cases, it may even be US origin goods and technology. So that's a real task. It can be difficult to map out all of those connections, but it's absolutely essential these days for financial institutions in particular to understand this issue so that they can make that nuanced decision when they're presented with it.
Thank you, Nick. And I guess you raise an important point. I suppose there's a little less, with regards to the recent sanctions, there's a little less certainty about the potential cost of non-compliance at this stage anyway. But I would like to turn to Rachel, on this topic, the cost of non-compliance, because I understand, Rachel, at Fenergo, you've recently released a mid-year analysis of AML and sanctions, the penalties and so on. I wonder if you can talk a bit about the sanctions activity and related fines we've been seeing historically, and how that figured into your analysis.
Sure. This Some interesting trends, I guess, from the analysis that we've looked at over the last number of years, actually. So our most recent full report was published earlier this year and was dated up until the end of 2019. So we've looked at the figures as far back as the beginning as such of the financial crisis in 2008. And so far, we've seen over 40 billion being issued in financial penalties to financial institutions across the globe. And a significant portion of them is as a result of sanctions violations. In particular, in 2019, there were 2.4 billion sanctions violations enforcement actions issued by almost exclusively by US regulators and the OFAC for violations against the OFAC programs. So that's quite a significant portion of penalties that were issued in total in 2019, which was just over 8.2 billion. So we're talking 30% of financial penalties issued in 2019 associated with sanctions violations. And that of course doesn't take into consideration the potential additional fines that were issued that could have resulted in sanctions violations. So things like insufficient policies and procedures around AML, KYC, etc., also make up a pretty significant portion of penalties that are issued. And obviously, where you have insufficient policies and procedures, that can, of course, lead to some degree inadvertent sanctions violations. So having those systems and controls in place is critical. And then interestingly, actually, this year so far, we've published our mid-year findings. Financial institutions haven't been issued any penalties so far this year by OFAC. However, we have seen one come from the UK, the OFSI, so that was issued earlier this year as well. So there is a bit of a shift this year, although there are some indications, and perhaps Nick will have seen this recently as well, just overnight. In fact, OFAC have published their revised penalties that can be issued in relation to violations, and that's in response to inflation rates. So there seems to be, just in recent weeks, a lot of activity coming out from some of the US regulators in particular, highlighting their powers or their ability to sanction individuals or financial institutions. So my expectation, or my best guess, is that we're going to start to see some activity in terms of enforcement actions in the coming months.
And that's probably a perfect place to turn to Nick on. I think a lot of financial institutions, I'm hearing there's still a lot of uncertainty, even with regards to the Hong Kong or Chinese officials that have been sanctioned. There's uncertainty as to whether they could potentially be penalized, with a fine, whether they could lose access to the US dollar, the US financial system. I wonder if you can offer some clarity on that, Nick.
Sure. In order to understand this, I think we have to divide the issue into two parts. Usually in the sanctions world, we like to talk about primary sanctions and secondary sanctions. A primary sanction, that's really where a US government agency would have some kind of administrative enforcement jurisdiction. That means that they would be authorized to penalize you with a monetary penalty, or in a serious, the US Department of Justice could even bring criminal charges. That's primary sanctions. And then secondary sanctions is something different. That's where an agency doesn't really have administrative jurisdiction over you, but they want to influence your behavior anyway. So they will try to threaten some kind of consequence to discourage you from engaging in an activity which is offensive to US policy in some way. That's a secondary sanction. So when we talk about these monetary penalties, we're talking about cases where, say, a bank has involved a US correspondent account or their US-based branch in a series of violations, usually knowingly engaging in some fairly egregious activity. And that's where you end up seeing these very big penalties. BNP, for example, $8.9 billion several years ago, things like that. Now, secondary sanctions, this is coming into the picture with Hong Kong, because under the Hong Kong Autonomy Act, Section 7, there's a menu of 10 sanctions that could be applied against any foreign financial institution that knowingly engages in a significant transaction with a foreign person who's identified under a different report in the Hong Kong Autonomy Act. Why this matters is because we're waiting for that report to come out, but there's been 11 people sanctioned under an executive order in relation to Hong Kong. The big question here is, will those same 11 people be on the report that's coming out under the Hong Kong Autonomy Act, or will it be different people? Will it be fewer? Will it be more? We don't know. We also aren't exactly sure what a significant transaction is because the Treasury Department hasn't provided specific guidance on this yet. So financial institutions are in this place where they may have business relationships. They may be able to manage those relationships without tripping over the primary sanctions, but there's still this cloud hanging over them because there's kind of a threat under this Hong Kong Autonomy Act that they could be sanctioned from this menu of 10 different sanctions for having these business relationships with with government officials and entities in Hong Kong. It's obviously a very complicated issue and one that requires a lot of careful decision making. But that's what people are primarily concerned with these days, and we're awaiting guidance from the U.S. government on these issues.
Thank you, Nick. I'd hate to be a compliance person at a bank at the moment, I guess. And saying that, I'd like to ask Ola to sort of respond to some of the things you've just said. With regards to, say, for example, I suppose there's sanction screening and PEP screening, and there are different sort of processes. But given that some of these sanctioned individuals are also PEPs, I wonder how that sort of impacts the screening process at a bank. And just generally, I wonder if this is kind of placing a bigger compliance burden on the bank, and whether it might be that way for a lot of other banks in Hong Kong at the moment. Any thoughts on this, Ola?
Yes. First thing is that it's fun to be compliance right now, to be compliance officer in those times. Well, sanctions, PEPs, and other high-risk individuals or entities, this is not uncommon that there are meeting points between those two, right? We've seen sanctions more and more used as a political tool. So naturally, some of PEPs or SPFs, as they're called in other regions, there may be sanctions at the same time. Now, detection, it probably depends on the maturity of the program, of the development of technologies that the banks have. Ideally, we would like to have a holistic approach to customer relationship, to be able to assess sanctions risk and PEP risk at the relationship holistically, to look at the relationship from various angles and understand the relationship between those risks. And some banks will perform PEP screening and sanction screening as one process. Right. Some banks do it in more decentralized and fragmented way across their offices in the region or even across the globe. And of course, the second group of banks will carry a heavier burden because they're running the risk of miscalculating overall risk of the client if they do not recognize all this information, if they do not put it together. And sometimes it takes a lot of time, and sanctions required quite a swift response. So ideally, we should be, as an industry, we should be doing this holistically: PEP screening, sanction screening, and any kind of adverse media screening.
Maybe Rachel, you can also talk to some of the technology aspects of sanction screening and PEP screening.
Yeah, and exactly to Ola's point, in some cases you do have a different approach, which really creates a difficult process to manage or collection of processes to manage. Brought me back to when I was previously working as a compliance officer, and some of these checks were being done manually whenever the SDN lists, for example, were updated, and it's really just creating opportunities for human error when you have those approaches to sanctions and PEP compliance. So one of the processes is creating an environment where you can automate some of those screening or checks, I suppose, for want of a better phrase. But the first part, from my perspective, is creating the overall hierarchy or the entire view of the entities and the related parties that need to be screened in the first instance, and then obviously being able to identify the results that are going to have an impact on your risk ultimately and your due diligence requirements. We know that there's obviously a focus not only on the individuals who are placed on a watch list from an SDN perspective, but also the entities that they're associated with. So both are important. When it comes to PEPs, it's a little bit different. So you have obviously individuals who are PEPs that are not, anything to be concerned about, but certainly have an impact on the risk score and warrant additional due diligence, but not necessarily something that has to be off-boarded or any other severe or extreme measures. So really creating that environment where you can capture that ownership and control structure accurately, where you can keep that up to date as well. So having potentially third-party integrations or data sources that help you to do that. And ultimately creating an environment whereby, anything that is considered, either a low value task, for example, or a low risk task, where things like that can be automated, it really lets the experts focus on the areas that they need to focus on, which is where that human expertise is necessary.
Thank you, Rachel. I don't know, Nick, maybe you can talk about some of the key considerations or complexities that financial institutions need to keep in mind when sort of designing PEP screening programs.
When it comes to PEPs in particular, and I'm thinking of Hong Kong especially, we often see AML-related enforcement actions where it's clear that a financial institution hasn't implemented effective controls for identifying and monitoring PEP accounts. I don't want to say I'm surprised, but I think it's clear based on some of the regulatory actions that we see that this is an area where some financial institutions still have room for development. What makes it challenging, I think, is beyond just figuring out the technical aspects of screening. The definition of PEP isn't clear always. It is a broad definition, and over-reliance on databases without actually considering what you know about your customer, which might point to them being a PEP, is one area where you might slip up. The other is making sure that you're able to identify close family members and close associates of PEPs who also would be captured by that definition. When it comes to sanctions in particular, where we have this overlap, the rules can get very fuzzy because when it comes to sanctions, the sanction really just applies to the individual. But when we look at PEP screening, we tend to look at a broader relationship, and we look at a set of individuals who might be close to that PEP. And we can't confuse the rules because they are different. For example, if you have a spouse of a PEP, you would treat the spouse perhaps as higher risk. In sanctions, the spouse definitely be higher risk, but actually wouldn't be a sanctioned person. You would have to examine the accounts that you hold for these individuals. You would have to determine if they have any joint property that you're holding, because any property that's held jointly that has at least one SDN beneficial owner would still be considered blocked. On the other hand, things which a non-SDN family member owns on their own would not be blocked. But then you also have to look for cases where that non-SDN family member might be acting on behalf of the SDN in a way that would be prohibited. So for example, trying to process transactions through the US financial system. So that, in just a few sentences, is a small bit of the complexity that financial institutions face. We do hear sometimes that some companies just want to stop doing business altogether with PEPs. They think it's too much trouble. I'm not sure that's the right approach, but maybe Ola has something to say about that.
I was going to ask Ola as well, because so it's not really only about, I guess, identifying the PEPs is part of the process, but then it doesn't necessarily mean you don't do business with them. You have to do the due diligence, do the risk assessment, and then sort of make that judgment. I wonder if you can talk about this process a bit, Ola.
Indeed, some banks choose not to do business with PEP, but most of the banks would not exit PEP relationship. Their client, like any others, have access to products. It's just that the risk has to be managed carefully. PEP detection and identification in the bank, it's no major innovation here. It's just screening, right? It's either periodic screening up on onboarding, and etc. And it can be done probably in two different ways, being the first one less popular, but it can be done against in-house built systems or databases that are maintained by the financial institutions themselves. But it's also it can be done using vendor-provided lists or vendor-provided tools or solutions. And vendors can furnish the banks with databases that are living lists, right? They are being updated almost every day. They contain more information than just PEP. They can contain adverse media, sanctions, and they allow banks to have more holistic approach. Again, the PEP risk, the risk introduced by PEP should not be seen in isolation. Ideally, we should be looking at the customer relationship from multiple angles. It's just how we detect them is the key.
I guess maybe Rachel, you can add to this from a technology perspective as well.
Yeah, so again, being alert to changes in profiles too is really critical. So I think, particularly when we're having conversations, we tend to focus on the onboarding of an individual or a relationship. But obviously things can change over time. So being alert to those changes is really critical. And one point actually that Nick made just in relation to PEPs as well is around the definition. So definitions have changed around PEPs in recent years. And actually what you can see in some jurisdictions is that there's direct conflict, particularly where it comes to individuals who no longer hold office. In the UK, for example, after a period of time, you're not considered to be a PEP. And there's actually requirements from the UK regulator's perspective to not over review or not over supervise or monitor, if you like, customer. So that's obviously going to be in directly contradict with other jurisdictions where they sort of take an approach that once a PEP, always a PEP. And again, you have the issue then around the known close associates, the family members as well. So trying to manage all that, and I know even just a few sentences that Nick gave around complexity, that it continues to become more complex as you look at more jurisdictions. So having that, I suppose, rules-driven approach to some of these challenges can certainly help from a technology perspective.
I'd like to hear a bit more from Nick on maybe perhaps some expectations or timelines, what we might expect for the rest of the year or moving into next year. If you have any, I know this is a very difficult question and I've given you the hardest job here, but feel free to share your thoughts.
Well, I think we should expect the unexpected. You never know what's going to happen, and we are getting close to the election, so things could get a little bit unpredictable. But there are a few things that we're tracking that we at least do have some timelines around. The first will be Executive Order 13936. This was the executive order where we saw the 11 official sanctions on August 7th. It's possible there could be more sanctions brought under that executive order. Those could really happen at any time. They're likely to come into response to developments in the U.S. Hong Kong-China relationship. We're also watching for reports that come out under the Hong Kong Autonomy Act. In particular, there is a report that is supposed to be issued around October 12th, which is the report under Section 5A of foreign persons who have contributed to the erosion of Hong Kong's autonomy. Those are Congress's words, not mine. We're expecting that around October 12th, but it's possible that could be delayed. Following that report, we would have a 30 to 60-day window. And at some point, there would be a second report, which we call a 5B report, which would identify those foreign financial institutions that have knowingly engaged in significant transactions with the foreign persons in the first report. If the timeline holds, that would come out around November or December. Now, if that wasn't enough, we also have regulations from the Commerce Department related to WeChat and ByteDance, which are supposed to come out around September 20th, so just around the corner. And we're also expecting more developments around the South China Sea. And I'm sure everyone noticed there was a list published by the Department of Defense on Chinese military companies, which is not a sanctions list, but could suggest that there are economic sanctions that could follow from the publication of that list. So yet another issue to pay attention to.
I hope our listeners have been taking notes. But yeah, just kind of trying to keep track of all that information, and it really just, I understand, scratches the surface. I wanted to ask you, Ola, about sort of the data component. So seeing as this is sort of a RegTech conference, the technology and the data components sort of fit into this discussion. Could you talk a bit about the data requirements and the access to data and how that impacts the risk that a financial institution might face in their screening programs?
Sure. In financial institutions, data is the key. Data is the key. Without data, there's no decision can be made, right? So especially in sanctions world, where those decisions have to be made quickly, there's access to data in a structured way has to be very quick. We have to minimize the data collection process and allow space for decision makers to make those decisions based on the data. And in the banks of international presence, it becomes critical to have this data structure and consistent, because it rarely happens that sanctions-related decisions are limited only to one office or one location. It's a bank-wide decision. So data is absolutely critical. Data is the key in financial institutions.
Rachel, maybe you have something to add to that?
Yeah, absolutely. So just in terms of the data, so again, capturing that data in a, I suppose, in a structured manner. So depending on where you're getting that data, but also being able to rely, I suppose, on the source. So what are you actually doing with it? So it's one thing to obviously to get the data, but how is it then being processed or used in that decision making? Where you're automating some of those processes, obviously it needs to be done in a sensible and responsible way. But also then who is actually making those decisions? So can you control that process in a rational way so that the right people are making the right decisions at the right time, and ultimately that the right actions are being implemented depending on, whether it's a sanctions result or a PEP result and so on. But ultimately being able to take the information that's being provided in the context that it's been provided. So not just assuming that everything needs to, be treated the exact same way. There does still need to be decisions made. So as I said, at the right time by the right people.
So I just kind of, I guess we have just a few minutes left. But I'd kind of maybe like to go around, and I suppose a key part of this conference is that whole technology theme. I'd like to see if you have any thoughts on sort of how technology can contribute further to sort of mitigating some of these risks when it comes to sanctions and PEP screening, identification, screening, due diligence, and so on throughout the process. How do you see technology fitting in to this whole process?
Typically we've seen that manual approach, and as I mentioned, I myself remember searching through customer and client records to identify new SDN or new additions to the SDN and consider the potential exposure. So where things like that are cutting down that manual processing time or that manual searching time, but also particularly where we have financial institutions that are working on legacy systems that don't necessarily speak to each other, or where you haven't captured information in a consistent way. So I've certainly seen examples in my own past lives where you'll have an individual that's associated perhaps with multiple accounts, but because of the way that the information's been captured, it's not being, their PEP status, for example, isn't reflected in each of those instances. And that's a really big concern, particularly when it comes to regulatory supervision and so on. So really creating that environment where you have a single view of your customer base and that you have immediate access to all of the, or immediate sight, I suppose, of all of the exposure if you identify whether it be a sanctioned individual or an individual that's identified as a PEP. And really that helps you to manage that risk exposure in a more holistic way, rather than, hoping that you happen to have all of the I suppose the records earmarked. Having that single view with all of the consistent information is really critical.
Anything to add to that, Nick, Ola?
Well, I think all three of us have worked as a compliance officer at one point or another. And one of the things that we discussed before, which I think is true, is that sanctions, as interesting as it is from a political point of view, is really about technology. For financial institutions, if you had just one customer and one transaction per day, sanctions would be a piece of cake. You could just look at it and take as long as you wanted to. But we have millions of customers and millions of transactions, and the only way to screen those and identify the sanctions elements are through technology and by understanding data, how systems fit together, how to build a process and a workflow, and to incorporate that with your human assets in order to solve a very complicated problem and protect institutions from the risks that we've been talking about. So I like to say that, compliance officers these days, especially in the sanctions field, have to get comfortable with technology. And if they're not, they need to start learning. That's why events like this are so important. They provide a way for people to learn. And there's a lot of good information online and elsewhere. And of course, there's always lots and lots of very knowledgeable people within financial institutions and other companies that you can learn from and that are happy to teach. So I would just encourage everybody, if this is something new, take the opportunity to really delve into the topic, learn a few things about how the systems work, learn what a field is, learn how to map to a screening tool, and try to figure out the workflow, and it will make you a much better compliance officer.
And if I can add, regulatory technology or compliance technology available, high level of customization. So probably there's nothing that providers of the tools could not do for the bank. So banks should define what exactly is the business need, which data points are important, and then speak to the vendors about it. And from my experience, everything is possible. All that is possible. And like Nick said, 21st century, we cannot be scared of this. We just have to work with technology. We have to use this technology smartly to identify those sanctions risks.
So I guess just kind of a minute or two left. Rachel, just some final thoughts before we wrap up?
Yeah, I mean, back to my original point around the enforcement actions and the value of those fines that have been issued. So, I mean, take that out, and there's also the reputational damage that we see as a result of whether it be sanctions violations or just insufficient AML controls and so on. So the cost of compliance is more than the penalty that's issued by the financial supervisors and regulators. And we've seen, particularly over recent years, significant global scandals that have been highlighted and brought to the domain. And certainly, I know Ola mentioned that it's cool or fun to be a compliance officer now, and it really is, because you've got people that are all of a sudden interested in the world of money laundering, and that can be as a result of pop culture and so on. But certainly these stories have become more and more prevalent, and certainly more and more extreme in some cases. So really highlighting the importance of these controls is more than just avoiding financial penalty. It's also avoiding, obviously, financial crime from continuing, but also that reputational damage from a financial industry perspective too.
Thank you so much, Rachel. And thank you, Ola. Thank you, Nick. With that, we've run out of time. So I know there's probably a lot more we could talk about on this topic. It's always a challenge with timings of these types of events. But yeah, if anyone has any questions, feel free to reach out to us. Thank you so much, Nick, Ola, and Rachel, for your time today. Thank you for our listeners for tuning in.